Hey guys, in today's video we're gonna talk about the main risks of investing in Chinese companies and the reasons why you don't really own the Chinese stocks that you buy. Many people who invest in Chinese companies such as Alibaba, for example, have no idea that when they buy shares with the ticker symbol BABA through the New York Stock Exchange or any other stock exchange outside of China, they are not actually buying Alibaba shares. They are buying a third company that mirrors Alibaba's financial results. And the same happens when they acquire any other Chinese publicly traded companies out of the Shanghai Stock Exchange. You don't believe it? Stay here with me and I'll explain to you how it all works so that you won't put your money at risk. The whole story starts with the Chinese government, which prohibits anyone who's not a Chinese resident from buying shares on the Shanghai Stock Exchange. Only Chinese residents are allowed to invest directly in publicly traded Chinese companies. So how is it possible for you to open your home broker and find several Chinese companies being traded? In order to avoid this government restriction, the market ended up creating structures that enables investors from outside of China to indirectly expose themselves to Chinese companies. This is how the variable interest entities VIEs were created. When an investor buys a share of a company listed on the US stock exchange, such as Alibaba or Tencent, they are not buying a share in the capital of the Chinese Alibaba or Tencent. What they are buying is an equity stake in a company listed in the Cayman Islands, which is a tax haven in the Caribbean. This company, located in the Cayman Islands, bears the same name as the Chinese company and ends up investing in another Chinese company, which in turn has a contract through a variable interest structure for a stake in the Chinese company's profits. Here we can see how this structure is built, and you can be aware of how the stake of the company you buy on the American Stock Exchange is not linked to a direct equity stake in Chinese companies. So when you buy shares in a Chinese company listed on the US Stock Exchange, you are actually buying shares in another company which has a contract that gives the right to a stake of that Chinese company's revenues or profits. And it's very interesting to note that the Securities and Exchange Commission allows these structures, the VIEs, to report their results as if they were Chinese companies. So when you open Alibaba's financial statements, which are reported in the United States, you are actually seeing a copy of the financial statements that the Chinese Alibaba reported, even though there is no stake on the Chinese company's equity. In short, when you buy Alibaba shares or any other Chinese company listed in the United States, you are buying a mirror company listed in the Cayman Islands, which indirectly has a contract that entitles you to a stake in the profits or revenues of the original Chinese company. Another important thing is that the legislation related to these VIE structures is kind of gray in relation to both US and Chinese legislation. Even if you look at the income statements of these companies when acquired outside of China, you'll see that one of the terms that appear the most is variable interest structure. In the risk part of the income statement, which is made available by Alibaba itself, it's mentioned several times that there is a very relevant risk of this type of structure, which was created precisely to try to circumvent this limitation that the Chinese government established on investors. If the Chinese government changes the legislation, it's possible that you will lose all your invested capital. Not to mention that the reporting of companies listed in China is by itself quite questionable and not as standardized as it is in the United States. All these data are released by the Bank of China, and we can't be sure of the level of accuracy of the information that they provide. As if that weren't enough, there is still an additional risk when investing in Chinese companies. Recently, there was a situation that caused a 90% loss to investors who bought some Chinese companies without being aware of this risk. In July of this year, the Chinese government made some important changes to the legislation that relates to education companies in China, stating that these companies could no longer use the stock exchange to raise capital and that they could also no longer raise funds from abroad. When we look at the two main Chinese companies in the sector, we can see that shares have fallen by more than 85% since the announcement was made by the Chinese government. New Oriental Education and Technology Group shares fell 86% since then, and Tao Education Group shares also dropped from more than $60 to 4.41, which represents a 91% loss in just a few months. And obviously this impact ended up spreading out on several other Chinese companies because after all, these government measures could end up also being applied overnight to any other companies in the Chinese market. Alibaba's shares dropped 46% in the last 12 months. The stock went from a little over $300 to $149 at the time I'm recording this video. So you should always try to understand the risks you are taking when you make new investments, especially when it comes to China. And how can you be aware of the risks you're taking? On the investor relations website of each company, you will find on the 10K forms all the risks that the management understands to be relevant risks for the company. And sometimes there are some very important things that you end up learning about a more specific risk for that company. And for companies that are listed outside of the United States, you can find this information on the 20F form, as is the case for companies that are listed in China. For me, personally, nothing justifies the risk of losing 100% of my invested capital quite abruptly, which is the case when the rules can change overnight and I can lose all my money. I'd rather have companies in my portfolio that sells in China, like Tesla for example, because the Chinese government may come to a point of banning companies that are not Chinese, but that would be a much more drastic step than simply making some kind of change on the Chinese companies themselves. So I prefer to expose myself that way. I also don't have any company that sells 100% of its products in China, but investing in companies like Tesla is a way that I have to expose myself and also gain from the growth of consumption in the Chinese market. But it may be that even being aware of all these risks, you are still interested in investing in Chinese companies. After all, the Chinese market has been growing a lot. China's GDP has grown significantly in recent decades. Just to give you an idea, in 2000, China's GDP was $1.2 trillion, and today that number is over 14 trillion. So if you want to invest in the Chinese market and you're not a Chinese resident, maybe the best option for you is to invest through an ETF, which is a vehicle that replicates a certain index. In the United States, we have the iShares MSCI China ETF, ticker symbol MCHI, which replicates the MSCI China index with more than 700 companies that are listed on the Chinese stock exchange. This ETF charges a fee of 0.59% per year, which is not such a high fee, and this percentage is already discounted from within the ETF. So, what do you think about Chinese companies and Chinese ETFs? Are you willing to take the risk? Please let me know your thoughts in the comment section below. I hope you guys enjoyed this video. Please don't forget to smash the like button and subscribe to the channel for videos of some of the greatest companies to invest. See you next time.